Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Denison Mines.
If you find our talks useful, please consider subscribe, like, and comment underneath. So today we're looking at a company that seems to be sitting on a bit of a paradox. We're looking at Denison Mines, ticker DNN, or DML if you're in Toronto. And looking at the financials, I sort of have to be the buzzkill right out of the gate. I'm seeing a market cap in the billions, a stock price hitting multi-year highs here in January 2026, and yet I see almost zero operating revenue. I see negative income. I mean, if this were a lemonade stand, they haven't sold a single cup yet. Why are we talking about this?
That is the perfect question to start with, but honestly, if that financial snapshot scares you, you're looking at the wrong sector entirely. You have to flip your mindset here. We aren't looking at a utility company that's going to pay you a dividend next quarter. Denison isn't a producer yet. They are a developer. You aren't buying them for the cash they have today. You are buying them for the assets they own and the massive cash flow they are projected to generate starting, if all goes to plan, in mid-2028.
Okay, so we're buying the blueprints for the lemonade stand, not the stand itself.
Even better. You're buying the land where the lemons are already growing, and you've got the permits pending to build the most high-tech juicer the industry has ever seen. The core value here is the Phoenix project at their Wheeler River site.
Right.
This is said to be Canada's first new large-scale uranium mine since Cigar Lake. That is a massive deal. We are talking about a project that is poised to come online right as the global uranium supply crunch is expected to really bite.
But let's stay on the money for a second. Mid-2028 is the target for production. It's January 2026 right now. That's 2.5 years of paying salaries, paying for drills, and keeping the lights on. How do they survive the valley of death? That period where developers usually run out of cash and have to dilute their shareholders into oblivion.
That is usually the killer for these junior miners. But Denison's answer to the survival question is actually one of the strongest parts of their thesis. They have an incredibly strong liquidity position. They aren't drowning in high-interest debt to keep this ship afloat. They rely heavily on equity and, crucially, joint ventures.
Joint ventures. So essentially bringing in roommates to help pay the rent.
Precisely. They are very smart about using other people's money to explore the fringes of their property. They bring in partners to fund the drilling on their less proven grounds, while they focus their own capital exclusively on the main event, Phoenix. They aren't paying dividends. Every dollar is being reinvested aggressively into de-risking the mine. They're doing freeze-wall testing, field trials, basically proving the engineering works in the real world before they commit to the full build.
You mentioned the full build. I saw the price tag on the Phoenix project got updated recently. It's not cheap.
No, it's not.
Yeah.
The initial capital cost, or CapEx, is now estimated around 600 million Canadian dollars. That's about 437 million US.
600 million for a company with no revenue. That sounds like a lot of dilution coming down the pipe for current shareholders. If they have to issue stock to raise that money, my slice of the pie gets smaller.
That is a valid fear. But in the world of mining, for a project of this scale, 600 million is actually quite manageable. You have to look at the capital intensity. How much do you have to spend to get a pound of uranium out of the ground? Because of their method, which we'll get to, their capital intensity is extremely low compared to building a traditional open-pit mine. And here's where it gets really interesting. They have a competitive moat that is surprisingly wide for a company of this size.
Let's unpack that moat. Is it just that they are in the Athabasca Basin? Because I feel like every uranium pitch I hear starts with, "We're in the Athabasca." It's like a tech startup saying, "We're based in San Francisco."
Geography is part of it, sure. The Athabasca Basin in northern Saskatchewan is the Silicon Valley of uranium. It has the highest grades in the world, by a long shot. Denison controls about 457,000 hectares there. But the real moat isn't just where they're digging, it's how they are planning to dig. They are using ISR in-situ recovery.
Okay, we need to pause on ISR. I see that acronym thrown around constantly. For the listener who isn't a mining engineer, explain this to me like I'm 5. How is this different from guys with pickaxes and dynamite?
Think of traditional mining as open-heart surgery.
Yeah.
You cut everything open, you dig a massive hole, sometimes a mile wide, you haul all that rock out, you crush it, and you process it with chemicals. It's expensive, it's messy, and leaves a giant scar on the landscape. ISR is like laparoscopic surgery, keyhole surgery.
So minimal invasion.
Exactly. They drill distinct patterns of wells, injectors, and extractors. They pump a solution down into the ore body, essentially a specialized water mix that dissolves the uranium right there underground. Then they pump that uranium-rich liquid back up to the surface.
So no giant open pit, no massive trucks hauling rocks.
No giant pit, no massive tailings, piles of waste rock. It's cleaner, it's significantly cheaper, and crucially, Phoenix is designed to be the first ISR mine in the Athabasca Basin.
The first one.
That is a massive technical first-mover advantage. If they pull this off, they change the economics of Canadian uranium.
That sounds great on paper, but first usually translates to guinea pig. And this hasn't been done in the Athabasca before. Doesn't that mean there are huge technical risks? What if the ground there is different? What if the solution freezes? It gets to -40 up there.
That is the primary technical risk. You are right. The Athabasca has complex geology.
Yeah.
But Denison has spent the last few years running extensive field tests, literally freezing the ground to create a containment wall and running the solution through.
Wait, back up. Freezing the ground.
Yes, it's called a freeze wall. Imagine creating a giant cup made of ice underground to hold the mining solution so it doesn't leak into the rest of the groundwater.
Okay.
They drill pipes, pump coolant down, and freeze a ring around the deposit. They've been testing this extensively. The results have been robust. They've proven they can control the fluid flow. But there is another piece of the moat that de-risks this project, and it's surprisingly boring. It's not high-tech lasers or chemistry. It's a power cord.
A power cord.
It's the grid connection. As of recently, the connection to the Sask Power 138 kV grid is complete. It's delivering about 8.8 megawatts of power to the site right now.
Why is that such a headline? Don't most mines have power?
Eventually, yes.
Okay.
But usually, in a place as remote as northern Saskatchewan, you have to build a massive power plant yourself. Or you're trucking in millions of gallons of diesel fuel over ice roads to run generators.
Right, I see.
It's incredibly expensive and logistically fragile. The fact that Denison is already plugged into the provincial grid before they even start major construction, that is huge. It de-risks the execution significantly, it's cheaper, it's reliable, and it puts them way ahead of their peers who are still figuring out how to turn the lights on.
That makes sense. It's the difference between buying a vacant lot in the city with utilities at the curb versus buying a lot on the moon.
Exactly. And because of the ISR method, which is cheaper, and this grid infrastructure, which is cheaper, the feasibility studies suggest that Phoenix and their other deposit, Griffin, could operate at the very bottom of the global cost curve.
Being the low-cost producer is the only safety net in commodities. If the price of uranium crashes, the high-cost guys go bankrupt first. You want to be the last one standing.
Correct. And that brings us to the stock itself, because while the engineering is fascinating, the chart has been absolutely screaming lately.
It really has. I was looking at the price action over the last week here in January 2026. Denison has surged something like 25%. We're hitting new 52-week highs around $5.35 Canadian. Now, be honest. Is this just hype? Is this Reddit traders getting excited, or is there something real driving this move?
I don't think this is fluff. This looks like a genuine bullish breakout structure. You know I'm skeptical of dead cat bounces, where a beaten down stock jumps briefly before crashing again. This isn't that. This is a momentum-driven leg higher.
So it's sustainable.
The volume suggests it is.
Yeah.
We are seeing what we call accumulation. That means it's not just small retail orders. We're seeing consistent buying pressure that suggests institutional players, the big funds, are building positions. And it's not just the chart. The analysts are chasing it too. Canaccord and National Bank have both raised their price targets to the $4.85 to $5 range.
That's validating. It's always reassuring when the suits on Bay Street agree with the market momentum. But wait, if the target is $5 and we are already trading at $5.35, does that mean the stock is overheated? Are we paying more than the experts think it's worth?
That's a common situation in a strong bull market. The analysts are often chasing the price action. The fact that they are raising targets validates the direction, even if the price has momentarily sprinted past them. But it also signals that the developer discount is evaporating.
Let's talk about that vibe. We track market sentiment pretty closely. What is the street whispering?
It's not whispering, it's shouting. The quantitative sentiment scoring is strongly bullish. We look at recent major headlines, and 5 out of 5 were positive.
Yeah.
That is rare.
A perfect score.
It is. The narrative has shifted. For a long time, the story was, can they actually build this? Now, the narrative is focused on de-risking. That grid power milestone we talked about, the market loved that. It was concrete proof of progress, the path to final regulatory approvals. The market is cheering it on.
It feels like the developer discount is shrinking. Usually, developers trade at a steep discount because there's so much uncertainty. As that uncertainty vanishes, the price re-rates upwards.
Precisely. And the institutions see it. Canaccord maintained a speculative buy with that higher target. National Bank kept their outperform rating. They're basically telling clients, look, the construction phase is right around the corner.
And we can't ignore the macro backdrop. Uranium prices are hovering in the low $80 per pound. That's a lot better than the $30 we saw a few years ago.
It's a very healthy price. Plus, there is this massive sector rotation going on right now into clean energy and nuclear. The world needs baseload power that doesn't emit carbon. Solar and wind are great, but they are intermittent. Nuclear is always on. That realization is a massive tailwind for any developer in the Athabasca Basin.
So everything looks rosy, the tech is cool, the power is on, the chart is up. But I want to know what I should be watching now. We are in late January 2026. If I buy this stock today, what keeps me up at night for the next 3 months? What is on the calendar?
There are three main things you need to circle on your calendar in bright red ink. First and biggest, regulatory approvals.
The final rubber stamp.
The big one. The final regulatory approvals for Phoenix are targeted for this quarter, Q1 2026. This is effectively the green light for construction. If that news hits, it's a major catalyst. It transforms them from a company planning a mine to a company building a mine.
Well, okay, that's huge. If that gets delayed, the stock probably takes a hit. What's number two?
Drills are turning. The winter drilling program is kicking off right now. Specifically, watch the Russell Lake joint venture. They are partnering with Sky Harbor there. They have a 15,000-meter campaign planned. And they're also drilling at Cosa, near Cigar Lake.
Why does drilling matter if they already have the Phoenix deposit? I thought we were focused on building the mine, not finding more uranium.
Because mining is a depleting asset. Every pound you dig up is gone forever. You always need to be finding the next deposit to keep the company alive long term. Plus, if they hit a high-grade vein at Russell Lake, it adds immediate value to the company's book without them having to spend much, thanks to the joint venture. Discovery is always a potent catalyst.
And the third thing?
Earnings.
But wait, we just established they have no earnings.
They don't have profits.
Yeah.
But they have earnings calls. This will likely be late February or early March. You aren't tuning in to see the earnings per share. You are tuning in to hear about the cash balance and the construction readiness.
Okay.
You want to hear management sound confident, bordering on arrogant, that they are ready to put shovels in the ground the second that permit arrives. If they sound hesitant, or if they mention supply chain delays, watch out.
Okay, I'm getting excited. But my job is to be the skeptic. Let's play devil's advocate. What could derail this train? Give me the bear case. Why does the stock go to zero, or at least cut in half?
It's vital to look at the risks, because in junior mining, the risks are existential. First off, CapEx inflation. We mentioned the cost to build Phoenix went up 20% to that $600 million figure.
That's a big jump. And in construction, does it ever actually come in under budget?
Almost never. The market mostly brushed off the 20% hike because everyone's costs going up, steel, labor, cement. But cost overruns are a classic mining killer. If that number creeps up to $700 or $800 million, the economics get worse. They might need to raise more money, which means issuing more shares, which means your slice of the pizza gets diluted.
And the timeline. Mid-2028 feels like a lifetime away in this market.
That is risk number two, the orphan period. That is the gap between the excitement of permitting and the actual pouring of the first barrel of yellowcake. That is 2.5 years of spending money without making money. A lot can happen in that time. Operational delays, labor strikes, regulatory shifts. They're exposed to market volatility that entire time.
And speaking of market volatility, commodity prices.
The big one, the 800-pound gorilla. If uranium drops from $80 down to $40 or $50, the math changes completely. Financing the mine becomes much harder. Denison essentially functions as a leveraged bet on the price of uranium. If the commodity crashes, the stock crashes harder.
Is there any mitigation there, or are they just a sailboat at the mercy of the wind?
Their saving grace is that low-cost structure we mentioned. Because Phoenix is projected to be so cheap to operate, they have a cushion. They can survive at $50 uranium where other mines would have to shut down. But make no mistake, a crash in uranium prices would hurt the stock price significantly.
Okay. We've looked at the good, the bad, and the ugly. I need a final verdict. Give me the elevator pitch for the investor listening right now.
I'm giving Denison Mines a bullish score of 8 to 8.5 out of 10.
That is a very high score for a pre-revenue company.
It's earned because of the quality of the asset. Here is the pitch. Denison offers leveraged exposure to a structurally tight uranium market. They own one of the lowest-cost undeveloped assets globally in Phoenix. It is construction-ready, grid-connected, and fully feasible. You aren't betting on a wish, you are betting on execution.
And the time frame. Is this a trade for next week?
No. This is a multi-year hold, call it 3 to 5 years. The goal is to capture the re-rating. You want to own it while it transforms from a risky developer to a stable cash-flowing producer. That transition is where the biggest gains usually happen in mining stocks.
Any advice for the tactical traders who can't wait 5 years?
Tactical traders can play the swing around the Q1 permitting news, buy the rumor, maybe sell the news. But honestly, the real value here is long-term. You want to be holding the ticket when they pour that first barrel.
Fascinating stuff. It sounds like the next few months are going to be absolutely critical for them with that permit pending. It's crunch time.
Absolutely. The blueprints are done, the power's on, now they just need the stamp to start digging.
Well, there you have it. A deep look at Denison Mines. Thanks for tuning in to Smart Wealth with Joshua. We'll catch you in the next one.